Velkommen til Rig på Viden, en podcast om forskning i investering, finans og økonomi. Mit navn er André Thormann.
Og jeg er Henrik Rasmussen.
Episoden har vi lavet i samarbejde med Nordic Finance and the Good Society, for at kaste nyt lys på finanssektoren i Norden og diskutere en mere ansvarlig retning for sektoren i fremtiden. Målet om at udbrede forskning inden for området og skabe debat om den finansielle sektor støtter vi 100% op om. Tag et kig på deres hjemmeside nfgs.dk, hvor der ligger masser af fed forskning og seminarer om ledelse, bæredygtighed, pengepolitik og meget mere.
In this episode of Rig på Viden, we will discuss what determines interest rates on the long run, and whether this have changed in the current environment. To help us dive into this topic, we have invited Economist Lars Christensen. Thanks a lot for participating again, Lars. It's a pleasure to have you with us.
It's my pleasure to be here.
Thank you. We do this in English today. We have done many podcasts in Danish, and we are both Danes, but let's see how it goes. Then we hopefully can reach a wider audience.
Hopefully.
First of all, you're connected to Nordic Finance and the Good Society.
Yeah.
Can you it's that research project that has been going on for approximately 3 years or something like that. Can we maybe start by you telling a bit on what you have learned throughout these 3 years and the project?
Well, the overall idea in the project on Nordic Finance and the Good Society is essentially to think about what challenges are facing the Nordic banking sector and financial sector in general. And obviously I have a background in the financial sector, so I have a professional background there. But I have a general understanding for that from an insider perspective. But my part of the research project has been from my core expertise in macroeconomics, finance, monetary policy. And if you look at the corner of my project, what we set out to figure out is essentially two things. The one thing is what determines interest rates over time. What's the long-term drivers of interest rates? Because we all know that essentially for the past 15 years we have lived in this low, some would say ultra low interest rate environment. Obviously that has changed during the period of the project, but we can get back to that. But even if we look at interest rates over the past 3 years, in real terms, they have just become even more negative. So one key question we asked ourselves: why are interest rates low? What can we make? What factors determines that? Do we have any view on that? The other thing is some key developments in terms of digital money. And that was the other challenge we wanted to look at in my part of the project, is the development of cryptocurrencies, so private digital money, but also the development and possible development of central bank issued digital currencies. And there is then a connection between the two factors, because if we are moving essentially from a world of traditional fractional reserve banking to digital currencies, whether private or public, that in itself could have an impact on banking, on monetary policy, and on interest rates. So that's the overall topics. And interestingly enough, of course, we've had then, in the midst of this, some huge shocks to the global economy, to the global financial system, to the conduct of fiscal policy, to the conduct of monetary policy, that has provided some insights into this, but doesn't change the conclusion, but just say, okay, there are further stories we need to tell here. So it has been extremely interesting to work on, and it has also been, you can say, well, we're doing research on something that is structural, something that is deep and fundamental and longer term, while at the same time living in a period of quite significant change. So it has also been, I must say, I have been so privileged to be doing what I really like, doing my advisory work for my own company, doing my private business, and then been a part-time researcher on this project, and that has to me been a very, very good combination, because I've been keeping track on what is happening in the financial markets, what is happening in the global economy at the moment as we are moving, but at the same time had time to think about what are the deep constants, so to speak, in finance and economics. And I've always felt that there is a lot of noise. So when I put off my advisory hat and my daily calls from clients, from journalists, for whoever who asks me what do you think about this and that, it's important to be anchored. It is important to be anchored in fundamentals about the world and how the world looks. And certainly the research project has been something that fits quite well into that way, and it's the way I think anyway. But it has been a good combination, and I think the research has benefited for me also being in the real world rather than just being in a university setting. I have also, I previously had I was a research associate at Stellenbosch University in South Africa, where I worked on monetary issues as well, and some of the research I did there has carried over into the new project, and I've found that also to be quite a benefit, that I essentially not have been in a 3-year research project, but in a 6-year research project. So that has been a benefit as well.
And if you look over the project, I mean, what have then been your key learnings?
I would say that the key learning, if you look at interest rates, is that whether we look at European or American interest rates, there's been this long-term downward trend, both in nominal and in real interest rates. Real interest rates, of course, being nominal interest rates minus inflation, or minus inflation expectations, whether how we measure it. And there has been this tremendous downward trend. We saw from the mid-60s inflation starting to pick up, both in North America and in Europe, around the world. And with higher inflation, you get higher interest rates, but you also get higher real interest rates because investors want the compensation for the inflationary risks. So, and that then peaked around 1982, both in Europe and the US. But from then on, we have seen this initially a fairly sharp drop in nominal interest rates and bond yields, but real interest rate took a lot longer. And that's actually a learning I would like to point on, which I think is highly relevant, is that once investors, consumers, labor unions, everybody start to think inflation is here to stay, inflation becomes ingrained, then inflation becomes quite sticky. And obviously that is then a key issue that really was interesting that I find in my modeling of interest rates, is that if we do different measures of inflation volatility, how much inflation moves up and down, and how that volatility moves over time, you would see that investors demand to be compensated for that. And when we started the project, there was no volatility in inflation. And it kind of, the discussion at that time, 3-4 years ago, well, inflation is dead. In fact, central bank was fighting to get inflation up. And suddenly we're talking double-digit inflation, both in Europe and North America and other places in the world, and runaway inflation in countries like Turkey. So suddenly inflation risks are back. So suddenly that finding that we knew from the economic literature, but we also empirical now can show that, well, it takes time. Once inflation expectations becomes ingrained, it takes quite a long time to kill it off. And that was a finding that initially wasn't too interesting, because that finding is not interesting in the sense that, well, if you're not in that kind of world with high inflation or rising inflation volatility, so that's a finding that that really is only covered in my models rather than in my papers, because that was not what we stipulated in our research project. We didn't want to talk about that, but that thing nonetheless comes out of the research and becomes highly relevant, and is something that I think should be covered more in future research, is that. But the other thing is, of course, that interest rates, or what Knut Wicksell 150 years ago, Swedish economist, called the natural interest rate, is really determined by the underlying growth pattern in the economy, so productivity growth. It's determined by demographics, an aging population, and that has impact through different channels. It has an impact through the level of risk appetite. We know that young men tend to get into road accidents more than elderly men, and I say men here because that's the fact. And that's not because they're worse drivers; it's because it's simply taking more risk. We know that among criminals, they're more young than elder. That's a reflection of risk appetite. We know that younger men tend to gamble more than elder men. And again, there is a gender element in this, but we don't talk about that. But the reason I say that is, of course, that if a population is aging, then you will have a shift towards less risk appetite, and then you will have a shift from risky assets towards less risky assets. So you should expect a pickup, for example, in demand for bonds, for government bonds that are normally perceived to be less riskier than, for example, stocks. So we can see, in the empirical studies I've done and others have done, that these demographic elements, depending on how you measure them, are a significant driver of why interest rates have come down, and that I think has particularly become a case since the mid 2000s, 2005-06. That probably start to be clear, visible in the data. And the way I normally illustrate that is to talk about if you look at an average American, they will retire when they are around 67 years old. If you go back to Second World War, the baby boom generation, those who were born just after the Second World War, we talk about the boomers, they come, it's essentially soldiers coming back, having a family, having children. So those being born there, then you can add 65, 67, 68 years to that. Then you get to 2008, 2010. That, of course, coincided with something different. Yeah. A great stop to the global financial system, monetary failure, stuff like that. But there was at the same time this underlying factor of Americans leaving the labor market. And in the process going into that, they're also probably changing investment patterns. You don't want to bet everything on stocks going into this. So there's probably an element of that. So the pattern is the same in Europe. It started much earlier, for example, in Japan. But that demographic thing clearly puts downward pressure through different channels on interest rates. And then, interestingly enough, it's depending on what kind of modeling you do, it's nonetheless quite hard to account for how low interest rates were after 2008. And some said that's because monetary policy is easy. But if monetary policy was easy, then we would have high inflation. So obviously monetary policy wasn't easy enough. And I argued many times, and as you know that, we have talked about that on your podcast before, I rather see there was a significant pick up in demand for money. And actually the demographics we talked about before would actually say that. If I become older, I become have less risk appetite, I will hold more cash. And actually I will also have preferences from a deflationary world rather than inflationary world. So that probably influences policymakers, that the electorates are becoming that we can see in Japan, Germany, where there hasn't been too much worries about deflation, but worries about inflation among the electorate. So, but it's hard to account for that. And then the work I've done on that is that what we've done after 2008 globally is implement significantly more financial regulation. And a lot of that financial regulation is telling banks, and other financial institutions to hold more safe assets, hold more bonds, hold more government bonds, hold more cash. In the old days, we will just say that this has been an increase in reserve requirements. And we don't do that anymore, but the financial regulation is essentially just doing that. And if we put that into our old models that we learned about back in the day, in my case, in the early 1990s when I was in university, then that would just say, okay, the money multiplier declines. When a declining money multiplier, private creation of money decreases, broad money growth slows, and exactly what we saw after 2008. And that would imply that also we get a more deflationary situation. Another factor that comes into issue here is central banks' ability to conduct monetary policy when interest rates are close to zero. I think one of the key learnings for central bankers after 2008 was that from when interest rates are at 10% and you control interest rates is at 10% or inflation is maybe at 6-7%. So you have high real interest rates and you have nominal interest rates. The way you conduct monetary policy is just control the central bank's monetary policy rate. It controls monetary policy through interest rates set by the central bank. When central banks are doing that, and they are then successfully bringing down inflation, so that's the situation where we were in the mid-2000s. Interest rates around 4%, inflation around 2%, real GDP growth around 2%. Like that was the steady state that essentially was the world from the mid-90s to the mid-2000s. So and that's also the period where we learned about the Taylor rule. The central banks were just sitting around with a joystick, moving interest rates up and down, given whether inflation moved a little bit above 2 or unemployment dropped a little bit below what we call the natural interest rate or natural unemployment rate. So monetary policy in that regime was very transparent and worked fine, very well indeed. But then we were hit by the shock in 2008. What nobody had talked about is interesting to read about John Taylor's original formulation of the Taylor rule in the 90s. He just assumes that the natural interest rates is constant because the period he looks at, it looks fairly constant. But indeed, during that period, natural interest rates declined, and that probably accelerated with the baby boomers leaving the labor market or starting to leave the labor market from the early 2000s and towards 2008-10. And so once that happens, you suddenly you're in a situation where when there's a shock to the economy and the natural interest rates have moved down, you have to push interest rates to zero. And that was happening in 2008. Central banks were not able to then figure out what to do next. Yeah. The Taylor rule was saying, interest rates, your monetary policy, Fed funds rates in the US, for example, should be -5. But it was 0. Therefore, monetary policy became far too tight. And so it took time to figure out how to conduct that. That was quantitative easing, just print some money. And that took time for central banks to figure that out. It took time for central banks to communicate that to the agents in the economy, to the consumers, to the investors, to labor unions, to understand that there was actually a method which you could use to ease monetary policy, even though interest rates already were 0. So the zero lower bound, as we called it, wasn't a problem for easing monetary policy. But still, central banks were reluctant to do this, and it's interesting. It has never been fully incorporated into the setting of monetary policy. Either if you look at the European Central Bank or if you look at the Federal Reserve, they come up with these new ideas. Every time they need to ease monetary policy, they introduce new instruments. Okay. They don't have a operational framework that, so to speak, is constant over time, that everybody understands. They will just introduce new, but there is now a general understanding that monetary policy can be eased even when interest rates are at 0. And I think if we look at the period from 2008 and until 2020, there's generally a perception that there was a risk of us hitting the zero lower bound again, and central banks would struggle with how to ease monetary policy. And particularly then in the environment where you are introducing financial regulation that is further pushing down the natural interest rate, particularly in Europe. And countries like Denmark, Sweden, we're talking about Nordic Finance after all, with extremely strong external balances, huge current account deficit. Danish current account deficit is approaching 20% of GDP at the moment. The Swedes have a similar thing. The Norwegians very large current account deficit, huge net savings, net wealth in all of the Nordic countries, or particularly the Scandinavian countries, and so you have that downward pressure on interest rates, and that hasn't gone away. I think that's important to recognize that. But what has gone away is that perception that central banks cannot create inflation, because we've seen that now.
That they can.
Yeah, and that was because, paradoxically, I believe the central bankers in 2000 and 2021, particularly 2021, that's where I thought the policy mistake was made. Thought, okay, we can just print money, and we will not have inflation. And then, of course, we got inflation. Contrary to 2008, where central bankers were terrified that if they printed money, they will have runaway inflation. So whenever they were printing money, they will tell anybody, once inflation starts to pick up, we will take away the money, and then that kind of undermined the policy. So they didn't have full commitment to monetary easing. You can say in 2021, we got, particularly in Europe and the US, a full commitment not to care about inflation, and then inflation picked up. So there has been, I believe, a change while we're undergoing this project that is not reflected in the research we've done, but surely in the podcast we've been making and other ways I've communicated our research through lectures and others, that some of the part of the story about low interest rates is gone. That thing that there was a deflationary risk. So you can think about it as a probability. What is the probability that we will hit the zero low bound interest rate, and therefore central banks will fail to ease enough? How big is that now? Well, in 2008, 2010, 11, it was huge. Now we know that they can ease, and they will ease monetary policy if needed. So compare the situation in 2006 with now. 2006 interest rates in the US is at 5%. Key policy rate, Fed funds rate. Now the Fed fund rate is at 5%. Let's see that now is a new shock to the economy, to the global economy. The Fed is forced to cut interest rates fast. I believe they will be cutting interest rates relatively soon, and should be. And then we hit the zero low bound. We hit zero again. Are there any people in the world who would doubt that they will then start to print money? No. We all know they will that. So now they have credibly committed to fight deflation if necessary, and they know they have the means to do it. Yep. Contrary to 2008. So from 2008, and I would say around until 2014-15, there was this perception in the markets, for global financial markets, that central banks were not willing or able to ease monetary policy enough, and therefore there was always the expectations were twisted in a deflationary risk direction. That is gone now, and I think, how much is that? I don't know, but that's maybe half a percentage point or maybe a full percentage point in terms of where interest rates ought to be in the long run. That being said, the models I have developed doing this project, for example, on 10-year bond yields in the US, indicates that, well, there has been noise over the past 3 years, a lot of noise, high inflation underlying. But the way the global bond markets now are priced relative to what I would put into the models is not way off. So more than 6 decades of what determines interest rates are still there. Okay. Interestingly enough, it seems like the impact of what I thought was important, financial regulation, I've written about that, how financial regulation impacts real interest rates, seem to be easing off. That maybe we should think about the impact of financial regulation in stocks and flows. There's one thing is that, okay, we tell all banks to hold more liquidity, hold more safe assets. In the period where they're introducing this, then it's having great market impact. It's having impact on the global economy. But once it's impacted, then or introduced, not introduced, implemented, I would say. So once central bank or once commercial banks are holding more liquidity, holding more safe assets, once that period of implementing that is over, then it's not having continuous impact on inflation and so forth. And this shock, because in that period that has been offset by central banks and printing relatively more money on offsetting those effects. But there was a period of introducing that, starting probably around 2010 and also 2018, I would say, both in the US and in Europe, where that had an impact that was lowering inflation. That is over with. So I really don't think that we are returning to the lows of the low, but because it's also hard to explain that. Just looking at the models, we had interest rates that were too low relative to what we could explain with any modeling. Other than that, just ad hoc factor called
modern monetary.
Oh yeah, that can't explain anything. No, that factor called
that came up a lot.
Yeah, that came up a lot. Yeah, we can talk about that. Some of these things are like, okay, we probably had discussion that interest rates will never be high. We can just print money without inflation showing up. We can just have central banks supporting public finances without that being a problem. I think that we now all understand that gravity has set in again. Exactly. That fiscal policy is having an impact on natural interest rates. If I think what's interesting is that a lot of the empirical work I've done. One of the things the problem with research is that when you're finding out something doesn't matter, you might never state it in your research because you're doing your regressions and you're doing the modeling, and so when something fails to show up being important, you don't write a long paper saying, I just tested all these factors and it didn't work. Yeah. And one of the factors that I did test a lot has been public finances, and it has been external imbalances, so current account deficits and surpluses. That it's hard to, if you look at, for example, the US, it's hard to look. It's incredible to look at the significant deterioration of public finances in the US over the past 20 years and say, why is that not showing up in higher real interest rates? And it's not. And it is not. And I still find it hard to understand why that is. And
because many people claim that is part of the reasoning, at least exceeding or higher public spending, right? That is also a key determinant of inflation.
Oh yeah, and I believe, I'm a monetarist. I believe that inflation comes from the fact that we print more money than is demanded. But what makes us print more money? Why do we print more money if we are central bankers? And why do market participants, labor unions, consumers, investors expect us to print more money? And I do think in that sense that that what has become known as some unpleasant monetarist metrics is important. That if we are in a situation where public finances are eased to such an extent that they become unsustainable, when it then becomes very unsustainable, particularly if everybody thinks, it's so unsustainable that the government will never be able to do something about this. They will have to call the central bank sooner or later, either directly or indirectly, to ease monetary policy. And you can say that was how it happened in 2020, 2021. That, essentially governments around the world said, this COVID thing, it's essentially a war. We therefore introduce war measures, we ease fiscal policy, we step out of boundaries, and central banks said, okay, it's a war. Then the fact that we are independent doesn't matter anymore. We are not independent, we are in here to support government finances. And surprise, then you get inflation. And obviously, yes, a lot of money was printed, but the fact that fiscal policy was eased in an unsustainable way and government said, well, we don't really care, and a lot of commentators were saying, "Oh, this is the way to move ahead." Obviously, these are reinforcing each other. So it's impacting. Fiscal policy can have monetary effect in the sense that too easy fiscal policy, unsustainable fiscal policy, becomes monetary in the sense that it creates expectations of future monetary easing.
But that is super interesting. So just to sum up here, because it's also important not to mix everything together, right? Because what you wrote about in the project was more the long term, the long term inflation basically, and that has been determined, or the long term low interest rates.
Yeah,
that has been determined by three things. I hear you say, right? Just to sum it up: productivity growth, demographics, and more regulation.
Yeah, and I should say in terms of productivity growth have of course declined rather significantly since the mid-90s, both in Europe and in the US, and that decline in GDP per capita growth, you can say, is reducing interest rates on its own.
Because what is the key question, as I see it, the $100 million question is then, have something structurally changed to those three long-term determinants of lower interest rates during the past years we have been through? I think that's what everyone is discussing.
Yeah, and I think, and that's the issue about. I think one thing is is what I talked about in inflation volatility, which when doing the empirical work, thought, okay, this is really important to understand why has interest rates dropped. But it probably tells us a little about where we're going in the future. And then, of course, we have an episode where suddenly inflation volatility and inflation itself goes up dramatically. And we also have a situation where it becomes clear that it's not given that those rules that are guiding fiscal policy and monetary policy are that stable. And then, of course, we have a war in Europe. And that war in Europe then essentially means that we are now gone from what we were calling a war and a pandemic to an actual war. But both factors means that the suspension of fiscal rules and of monetary policy rules just goes on. And of course, then it becomes a grind. That's like, okay, maybe that issue of inflation volatility, uncertainty about inflation goes up. And I think that on a personal level is something that worries me. And when I talk to clients in my private advisory business, I'm at the moment struggling to communicate, because this would be pension funds, hedge funds, it would be investors, generally speaking. And I would say, actually I think inflation is coming down faster than most people think, because central banks have stopped printing money, and we're actually seeing both nominal and real money supply dropping, both in the US and in Europe. And that is indicating that inflation should be coming down, and we actually should drop below 2% inflation, both in Europe and US, within the next 12 months. So that, that's happy-go-lucky. We should be happy, and maybe I'm not even that greatly concerned about that recession, because everybody thinks about, inflation equals crisis equals recession equals 2008 equals 10% drop in GDP. Well, that was because we were not able to ease monetary policy once real interest rates became, or the natural real interest rate became -4, because we hadn't figured out how to print money. Now we can first cut interest rates from 5 to 0 in the US. We can, in the case of Europe, not cut that much because we don't have that much, but we can allow the euro to weaken substantially, and we actually have done that. And then we can start printing money again. And so I don't see I don't see this massive risk over this 2008 like recession. Will we have a recession? I don't know. But if we're getting a recession, I much more likely see a normal post-Second World War recession that lasts 12, 18 months at the best, and at the worst. And we have a little bit negative, and unemployment might rise by 2 to 4 percentage points in Europe and the US. but will recover. It's not like a depression-style crisis. That kind of thing is never nice, but it's not 2008. And so what I'm saying here is that's really a pretty benign scenario. That's a benign scenario, and so that should also, in terms of interest rates, mean that, well, then for example, 10-year U.S. bond yield should return to something over the next, let's say, 5 years. 5 years is meaning that we can either go recession or we can have a smooth landing, whatever. Let's even say 3 to 5 years. 10-year bond yields in the U.S. close to 3%, and 3%, and we are getting there. We are just below 4 now, but and that doesn't sound like a lot. But if you're a market participant, 100 basis points is quite a bit. But in the big picture, if you're looking at the graph over 60 years, it's nothing. And so in that sense, it's a pretty benign scenario. But then I have this worry that the rule book has been thrown away. Yeah. That maybe fiscal policy isn't going to, we have seen in the US the debate over the so-called debt ceiling. Public finance in the US is a mess, and it's very clear that the two main parties in the US, or essentially the two own political parties in the US, don't care about the public finances. We're pretty sure that the next presidential election will not be won by a president telling everybody that we will cut public spending and hike interest rates to ensure sustainable public finances. Nobody will win that election. It doesn't seem like those are easy something they will win. And the Democrats are not going to argue for higher taxes, and the Republicans are not going to argue for lower public spending. They do it, they're saying, we want lower public spending on this and this, but what they really need to do is do major fiscal reforms in the U.S., and none of the political parties in the U.S. are willing to do that. So it creates that, and then I think that 2021, when the Fed clearly should have started to tighten monetary policy, and Federal Reserve Chief Jerome Powell said, inflation is transitory. Inflation has nothing to do with our monetary policies, and we're not even thinking about hiking interest rates. That to me was a shocking experience. And I talk to market participants every single day. I talk to also very experienced market participants. I talk to policymakers, and there's this general feeling of like, that was crazy. That was a bit crazy.
It was crazy.
And if you look at the ECB, it's even more crazy. You had ECB chief Christine Lagarde well into 2022 saying, monetary policy is not the cause of high inflation. This is the case particularly in Europe. There is these. I've said this before, and of course it's controversial having the views I have on this, because you're not allowed to talk about it. But if I look at how much central banks around the world, particularly in Europe, are talking about price stability versus other issues. Other issues being, for example, climate change is a major issue for central banks. I still fail to understand how and why this should be an issue for central banks. They have no instrument to impact climate change. Christine Lagarde has been talking about gender, inclusion, all these issues. These are political issues, and one can have the views you want to have on these issues, but certainly central banks do not have instruments to do something about that. And if you spend 60 to 80% of all your time in terms of communication about these issues, and 10-15% of your time, or whatever it is, on price stability, what are you telling markets? You're saying we don't really care about price stability. It's really not our responsibility. And it's at the same time, the war is going on in Ukraine. The Russian invasion of Ukraine has, of course, and rightly so, scared policymakers in Europe. And the need to increase defense spending in Europe is real. I'm personally a long-time advocate of doing that. But increasing defense spending will put pressure on public finances. And again, nobody in Germany, nobody in Denmark, nobody in Italy is saying, well, we need to finance that. We need to finance that by cutting spending other places. Nobody's talking about that, or increasing taxes. So essentially, we're just accepting a deterioration of public finances. How big is that deterioration? If that's, let's say, 1 to 2% of GDP deterioration of public finance across the board in Europe, well, that's a major fiscal shock. And how is that will increase the natural interest rates. And increasing natural interest rates, obviously, as again I said, I can't find that. I cannot find public finances having an impact on natural interest rates. So why am I nonetheless saying it? Well, because I believe in economic theory.
Yeah.
And obviously I can't show that fiscal policy have an impact on natural interest rates over time, for example, in the US, if you have most of the period where public finance are more or less conducted in a sustainable fashion. But I can see that through periods of war, I see inflation picking up.
Yeah.
And I can see that during the 70s, and it's very clear in the US, the Vietnam War, underlying and the big welfare spending programs of the people tend to forget that the US had major welfare spending increases in the late 60s. Clearly was a reason that to drive up natural interest rates in the US in the late 60s. The Federal Reserve at that point was supporting government's policies and kept interest rates low nonetheless. So that was inflationary. And we know that from other episodes. So it's not that it doesn't exist. And what I'm saying is that I have a problem of terms of communicating a 6 to 12 months forecast on where interest rates and inflation is going, and where I fundamentally say, okay, there is a pretty benign scenario. And there is also a benign scenario where my fears regarding public finance and essentially my fears about politicization of monetary policy goes away. But there is also a kind of 1970s scenario where we will keep on finding excuses of having too easy monetary policy because, there's a war going on, and but if we do this, maybe euro will break up. Or we can now see in Germany, we can see that the populist right, the AfD party, is gaining significant ground in the opinion polls, and obviously that is going to scare people. It's like, okay, if you're sitting around and you're sitting in Frankfurt in the ECB and say, hey, what's going on here? The largest economy in Europe is potentially going to see the political center move towards right-wing populism, which is potentially pro-Russian right-wing populism, supporting Ukraine's effort to defend its liberties and independence. If you see that, what are you going to say? Are you going to hike interest rates and say, we will fight inflation no matter what? You're saying, nah, you're probably not going to say that. And if markets start to say, the ECB's, it has been taken over essentially by European politicians. And that's the 1970s scenario. And I do see a risk of that. But how do we put that into predictions? How do we put it into models? Because these are not structural factors that develop gradually over time. This is more like like a binary model. We are either in this stage or we are in that stage. Yeah. And that's my thinking about it. So on the one hand, you can say I'm quite optimistic. We have been through a negative episode. Central banks failed, but they certainly realized they failed. And once Jerome Powell was re-elected in October, November 2021, he figured out that I need to return to stability. And if you look at markets, and if you look at labor markets as well, financial markets and labor markets, there is no major indication that there has been a shift in inflation expectations. Mm-hmm. Rather than if you look at European 5-year inflation expectations, so meaning inflation in 5 years and 5 years ahead. If you look at the markets for that, swap markets for that.
Because what I hear you saying is that there is two things that might have changed. We don't know, but there are indications, right? There are basically whether central banks are still as independent post-COVID as they were pre-COVID.
Yeah. Or maybe pre-2008.
Maybe pre-2008. So something about central bank independence, and we have examples of where it looks weird, basically.
Yeah, it looks shaky, it looks fragile.
Yeah, and that was your point also about throwing the rule book away, basically. The other thing is public finance deterioration, which basically comes from more public spending, as I hear it, right? So more military spending due to war economics, partly. But I have two questions here, and I'll just start with the first one. In terms of more public spending, how about the green transitioning? Is that inflationary, you think?
Is demographics transitionary because it's increased public finances? I think a way to address that is that I'm certainly no energy expert, so I'm always reluctant to have very strong views on energy and what we have done on energy. But I think it's pretty obvious that we have had a politically forced change in the energy setup in Europe in the past decade, and that has not been advised from our energy security perspective. It's pretty hard to see the rationale behind the closings of nuclear plants, both in Germany and France. That just seems today extremely hazardous. That like, why would you do something like that? Why would you move in that direction? And then while doing that, not only increasing cost of energy and thereby implementing a negative supply shock to the economy, but at the same time creating this enormous independence on Russian gas. That hardly can be said to be more green than nuclear power. The other thing, there is an element here is that I think a lot of what we call the green transition is politics rather than actual environmental policy. Being an economist, I think that if you want to lower CO2 emissions, you tax CO2 emission. Mm-hmm. That's just what you do. Or you introduce tradable quotas on CO2 as we have in Europe. And if you want to have less CO2 than is stipulated by the quotas, you just reduce the number of quotas to the issue. So I think that reducing CO2 emissions in Europe is very easy to do. It comes at a cost. But you can do that, and the most efficient way of doing it is through taxation, or CO2 taxation, or taxation of emissions, and or through tradable quotas. A lot of the other things that we now call green transition, to me, seems more like rent seeking. It seems like how to get a subsidy from government from doing something. It's a way to, the financial sector has talked a lot about green transition. It's like, banks by definitions are already green. A bank compared to oil company is enormously green. So go out and tell everybody you're green. And obviously banks have a good reputation, so it's an easy sell. So
But the only reason why I'm asking to just frame it again is this is a long-term trend, right?
Yeah, but my point with that is that if we pursue these goals of green transition using inefficient means of doing that, through subsidies to companies that don't need the subsidies, while you're not using taxes and quotas, which would be tradable quotas, which would be the efficient way of reducing CO2 emissions, then you're reducing productivity growth. You're reducing welfare. Yeah. If you do that, you're having the same impact essentially as we're seeing with demographics of slowing growth. The impact on that is worsening public finances. If you have that, then you have this tremendous continued downward pressure on public finances. And if you then have a situation where central banks have learned that the best policy for them is to bail out governments, then that's going to increase the natural interest rates, and it's going to increase inflation. Not on its own. And I think, demographics is an interesting issue here. If you look back, we don't talk about what has happened over the past 3 years, but just think about the demographic issues. How should demographics impact inflation? Not interest rates, but inflation. And my view would be that if central banks have a target of 2% inflation, and they conduct monetary policy in a way to hit that, then demographics have no impact on inflation. But it have an impact on money demand and has an impact on natural interest rates. So how could that impact then inflation nonetheless? It could impact inflation in the sense that if it reduces trend growth, it reduces and increases, also have the effect through consumers becoming and the population becoming having less risk appetite, reduces interest rates. So that would essentially, prior to 2020, put us closer to the zero lower bound, and central banks would have a problem conducting monetary policy in that environment, given they didn't have an operational feature about how to operate monetary policy in that way. That increases deflation or deflationary risk, and that's Japan. We have seen that in Japan for the past 30 years, that demographics seem to have played a role in reducing trend growth and real interest rate, and the Bank of Japan has been reluctant to use measures until recently to push to print money, even though natural interest rates were below zero, and then you got deflationary. So that impact could be there, but it could also have the opposite impact. And Charles Goodhart has argued that in a recent book, where he argues that this is worsening public finances, and the erosion of public finances will become inflationary.
Yeah, so because when people get older, we need to spend money.
We need to spend more money,
people.
And then public deficits will become larger, and I think Charles talked about this becoming inflationary on its own through public finances. I would argue it becomes inflationary only through monetary policy, but it increases pressure on monetary policies or policymakers to help governments by essentially creating more inflation. And I think that dynamics between governments and central banks is important. And we can see it now. Is that why has it has been very, very clear that the ECB has been gone out of the way to help governments. And I think a key change in Europe has been Germany. What we all there is this general perception that German policymakers are fiscally conservative. That they don't like public deficits and they would like low inflation, and I think fundamentally that a completely wrong perception about German policymakers. German policymakers are no different than Italian policymakers or Greek policymakers. And again, here these are the stereotypes of Europe, that the Greeks and the Italians like easy monetary policy. But what really determines the difference is the state of public finances. And if you look at Germany in 2010. the German economy was recovering very fast from 2008 because Germany was essentially selling cars to China, and China conducted massive monetary and fiscal easing post-2008 shock, and the Chinese economy grew very strongly in 2009-10. And so Germany was growing very strongly, and at the same time the euro was weakening. It was great for the exporting nation. At the same time, energy prices were low. So essentially you can say Germany was importing energy from Russia to produce cars to China. That was just a great deal in that period. At that point, Germany did not need easy monetary policy. Because if there had been easy monetary policy, then you would have runaway inflation, and you didn't need that because public finances was in a good state. But Italy needed that. Public finances in Italy was terrible. Public finances in Greece were terrible. Public finances in Spain were terrible because the shock had hit, and they didn't get help what was happening in China. They didn't import any cheap energy, whatever. So there was a difference between what the Germans needed and what the Greeks needed. You go forward till now. Who is suffering? Germany is suffering. Public finances in Germany is in terrible state. German policymakers have been going out of the. First of all, Germany had terribly expensive COVID policies. Germany was one of the most restrictive countries in the world. They kept restrictions in place for nearly far longer than anybody else in the world. Mandatory mask, school closings, shop closings, restrictions on traveling. Germany had more restrictive policy than nearly everybody else in Germany, in Europe, in terms of this. And at the same time, of course, China suffered greatly from the lockdowns they introduced. And of course, that had hit German exports to China very well. And now, of course, we know what's going on with Russia and that. So Germany is in a really, really bad state. And at the same time, during the aftermath of 2008-10, we had this idea that public finance is in a great shape in Germany. Or maybe Germany just benefited a lot from very easy monetary policy from the ECB, not for the entire euro area, but relatively easy monetary policy for what Germany needed. Germany needed tighter monetary policy. Greece, Italy, Spain needed easier. So we got in the middle of the road. Germany got too easy monetary policy. The Italians, the Greeks got too tight. What are we having now? Well, now really the German government would like monetary policy to remain overly easy. And so would the Italians. And so what I'm arguing now is that there's full agreement now among finance ministers, not central bankers, finance ministers in Europe, that the ECB really shouldn't tighten monetary policy too fast. And it's very easy to convince a former finance minister, a former politician, the lawyer Christine Lagarde, the ECB chief, that you need to keep on having easy monetary policy. I know they sound hawkish at the moment, but that's my was I a finance minister, or if I was a finance minister official, I would have a different view than Lars Christensen, the advisor to investors, because the advisor to investors will say, okay, I think we will be lucky. I think we will be close to avoiding a recession, and if you get a recession, it will be fairly mild. Inflation is likely coming down towards 2%, at least in the US, but probably also in Europe within the next 12 months. This is a pretty benign scenario. That's why I put on risk. Yeah. But if I was a policymaker, if I was a central banker, if I was a official in the Ministry of Finance, I would internally be saying, we need to get back to rule-following monetary and fiscal policies. That means we need to stabilize public finances, we need to cut spending, we need to implement fiscal reforms, and we need to conduct monetary policy in such a way that nobody doubts that we will ensure price stability. And so I'm split between those two. And in the academic role, I can luckily put on both hats, and I can see there are periods where number two was allowed to dominate, and that was the 1970s, where excuses again and again. There was what is important is that in 1967, and most people don't know this, even economic historians, and something incredibly important happened. the British government devalued the pound against within the Bretton Woods system by 14%. And why was that important? First of all, at that time, the dollar was not the reserve currency of the world. At that time, both the dollar and the pound were combined reserve currencies of the world. People wrote, and even though clearly the pound was losing ground, but so it was a tremendous shock when the Brits devalued and caused other nations, including Denmark, to devalue significantly within the Bretton Woods system. And then in 1971, we had the so-called Nixon shock when Nixon gave up, closed the so-called gold window, is essentially blowing up the Bretton Woods system. I was never a fan of the Bretton Woods system. I don't believe in pegged exchange rates as a general policy for all countries in the world. But when Nixon blew up Bretton Woods, he blew up the monetary anchor. There was no monetary anchor. And it was only until the early 80s we in the developed world started to re-establish some kind of monetary anchor. And it took until the early 90s before that was in place. So we essentially had a period, let's say from 1967 until the early 1990s, a period of 25 years, where we didn't have a monetary anchor, where we didn't have a rule book, and then gradually through the 90s, we talk sometimes about the Washington Consensus. Monetary policy should ensure price stability, fiscal policy needs to be in order, we need to undertake economic reforms and so forth. We need to have a free market-based system. All of these things that became in the 90s the consensus, and it created tremendous positive results in terms of lowering inflation and spurring growth, spreading wealth around the world. We have never seen as many people come out of poverty as from the end of the Cold War, from the early 1990s and until today. We haven't seen a period like that in world history. So it's just tremendous. But we forget why we got there. We forget why we had that stability. And that was because we were following rules. And the erosion of those rules don't happen from one day to another. The example I give is Turkey. When Tayyip Erdogan's AKP party came to power in Turkey in 2001, inflation in Turkey was 75%. Turkey had just gone through a tremendous economic crisis. And Washington Consensus policy was implemented. We had fiscal reforms, fiscal austerity, we had privatizations, we have market reforms, and then we have the Turkish Central Bank becoming independent, introducing an inflation target, inflation coming down rapidly, public finance improving, and it was that was a tremendously positive period for Turkey. Turkey's standby agreement with the IMF that essentially created the framework for these reforms ended in 2006. And at the same time, Tayyip Erdogan started to remove, or at least not reappoint, key liberal reformers, Minister of Economics, Finance, Central Bank, and we saw this move towards a more authoritarian regime, towards less market-based regimes, become more and more unorthodox. Of course, after 2016, after the military coup, of course, gone completely off the rails. Finance ministers changing every week, central bank governors being kicked out for not cutting interest rates to zero, and inflation, of course, skyrocketing. But it took essentially from 2006 to 2016, in my view, for markets really to discover that the reform period had ended. And you can see that for many emerging markets. You can see it for Russia, you can see it for Brazil, you can see it for South Africa, that a lot of these reforms that we saw really in the early 2000s in emerging markets that created stability, that created enormous economic progress, enormous foreign direct investment, and so forth, they ended before 2008, or started to end around 2005-06. And 2008 maybe blew that up. But when we're looking at markets, the they hasn't really realized that until quite recently. Obviously, the emerging markets hasn't been performing. But what I'm trying to say with all this, that if you look at something as fragile as Turkey, and we for 10 years essentially can keep the perception of reforms alive, even though it clearly had gone, then it will take more time to erode trust in fiscal policy and monetary policy in the Western world. We can have 1 or 2 years where we do the wrong thing. Yeah. But I'm just saying we're playing with fire. Yeah. But it's not given that we return to the 70s immediately. But next shock, we should demonstrate we have a rule book.
Yeah. We only have like 5 minutes left, so let's try to do this briefly, because I still have like 3 things I want to talk about, and maybe very briefly about this, because I think we don't talk so much about it anymore, but it is a change. Average inflation targeting, is a thing we rarely talk about, but it is implemented. Is that a structural driver of higher inflation? It's loosening up, basically, right?
What average inflation targeting is what the Federal Reserve has implemented in recent years. Obviously, one should remember that we talk about inflation targeting, and it's something that has been around forever. But inflation targeting hasn't been around forever. Inflation targeting was first mentioned at our FOMC meeting, so the Federal Open Market Monetary Committee, in 1986 by the then president of the Richmond Federal Reserve. He said, we should target inflation. They talked about inflation targeting. It was first implemented by a central bank officially in the early 90s by the Reserve Bank of New Zealand. And I think that if you go back to, let's say, 2006, everybody would say, what's the inflation target of the Federal Reserve? Like, the answer would be the Federal Reserve does not have an inflation target officially, but it's probably targeting 2 to 2.5% inflation. At that time, of course, the ECB was officially targeting 2% inflation. A number of central banks had at that time introduced 2% inflation targeting. What that meant was a little bit uncertain, because was that 0 to 2 or 2 plus minus 1? Or was it, if you were undershooting last year, should you then overshoot this year? Or how do we interpret that? And that central bank has never been very eager to say that clearly, unfortunately. But then the Fed, obviously the Fed and the ECB was struggling with keeping inflation at 2% after 2008. The ECB more than the Fed. But then the Fed introduced what they call average inflation targeting. And they did that in 2020. Yeah. And then going into this. And so what does that mean? Average inflation targeting means that if you have undershot inflation and your inflation target for a period, you are allowed to, or you should, overshoot your inflation target for the coming period. And the Fed thought that will never be a problem. That's just, and it makes sense in the sense that, okay, it's anchoring. Market participants know that if you've been too low, you will push more, and so markets will help the central bank achieve its inflation target. So in that sense, makes sense. It's similar to price level targeting. So instead of you saying you should have 2% inflation, you're saying the price level should grow by 2% a year. So if you're above that, you have to return to that trend. But that is harder to measure, so they just said average. But the problem was the Federal Reserve never said average for what period.
Exactly.
So does that mean that the past 10 years you are undershooting? So we can just take all of that undershooting and then add that up? That wouldn't make sense, because prices and wages and expectations adjust much faster than that. So it should only be for the period which we will say. And given what we've seen of research from different Federal Reserve districts, it's probably 5 years, meaning that for the average inflation over the past 5 years, plus the expectations for inflation for the next 5 years should average 2%.
Okay.
But again, the Fed never said that. But that again, that gave them lots of room to overshoot in 2020, 2021, because we had been undershooting in the 5 years prior to that. So that was a signal to markets that we're going to allow overshooting of money, which made good sense if you fear deflation. But the problem was that they were like, okay, you never communicated, you never added up the numbers. Because what if you then go to a period of then have 10% inflation like we had? Or we still have way before, and that's accumulating. Does that mean that going forward we're going to have minus 2% inflation every single year for the next 10 years? Exactly. Because we're getting to that. And nobody would say that would be a good policy. I would strongly advise against it. But that is actually the logic of the average inflation targeting. But if you notice, the Federal Reserve has stopped talking about average inflation target. And this was, by the way, similar to what the ECB did in around 2006. Until 2006, the ECB did not only have an inflation target, it also have a reference value for the growth of the money supply. The problem with that was that, not the problem, but the problem for the ECB was that ahead of 2008, from 2005 to 2008, M3, money supply in Europe, grew much faster than the reference rate. But inflation was still around 2%. That was an indication that monetary policy was becoming too easy. What the ECB should, of course, have done was to react to that. But instead, it just made the reference value. You can't find a press release from the ECB where it says, we have abandoned this, it doesn't work. You can't find that. It just disappeared. And I'm saying the same here with average inflation targeting. It's like, okay, everybody can see that this makes no sense. So now it's just like it disappeared. But should the Federal Reserve now formulate once again a new way of implementing the 2% inflation target? And it, of course, should. But then it would just see how many times have you introduced new rules, new instruments since 2008? And the ECB and the Fed continue to struggle with that. And again, the underlying thing is the erosion of the credibility of the central bank and of monetary policy, which create that, now we're going full circle, that inflation uncertainty that causes interest rates eventually to be pushed up.
I think that's the last point we need to have. I just have one question, and actually we agreed to talk about this in the episode, so it must just be a yes or no thing. Cryptocurrency or digital currencies in central banks. We spoke a lot about it. We even made an episode about it. When Bitcoin was the hot thing. Yeah. Now people don't talk so much about Bitcoin anymore for some reason, at least not compared to what they did back then. Is that just a project that have disappeared like average inflation targeting?
No.
Is it still ongoing?
I think one thing, I think underlyingly there are technological progress, and I do think that we are going to see cryptocurrencies in some shape or form continue to grow in importance. But I think what is important increasingly is central banks will issue digital currencies. One can discuss whether or not they should do that and the merits of that, but it's going to happen, and that is going to have an impact on these issues. And let me just shortly, we done an episode and then I wrote a research paper on it. How does that impact interest rates? How does it impact monetary policy and inflation? Well, think about it in this way. If a digital currency, whether issued by government or by a private issuer, is a way to hold currency without it being lent out. You know, we talk about wallets when we talk about bitcoins, for example. So unlike a deposit in a bank, when I deposit my money in the bank, the money is lent out again. That doesn't happen if I have some e-currency. No. Some e-currency I will hold in my wallet. It's not lent out to anybody. And therefore, imagine you tomorrow has something that is safe and you trust and is introduced, and you can use that at a zero cost. So I can have all my money there. There is no need for a deposit insurance scheme in that, because you never lend out the money, so the money will not disappear. It's like having the coins in your pocket. The reason we don't have our deposits in lying around is that that's unsafe. But if you create a safe digital currency that you can have essentially in your pillow, you would have that rather than like to have a bank account under most circumstances. And that would mean that once you introduce a cryptocurrency, whether government or private issued, then that would create an outflow from banks. And if you notice that discussion kind of popped up again after Silicon Valley Bank blew up, because some people are like, oh, what about deposit insurance? How can we guarantee banks? And some starting saying we need to have a safe alternative to commercial banks, and that could be a cryptocurrency, and that cryptocurrency could be private or central bank run. And if that happens, that would cause a so-called money multiplier to decline, and then that could create essentially a monetary tightening. And we are seeing some of that. Of course, if we look at the actual money multiplier over the past 1.5 years, it has been declining both in the US and in Europe, but particularly in the US. So the relationship between money created by base money and the broader money base, M2 for example, has been declining. That's because we're seeing outflow from banks. This is completely natural when we're tightening monetary policy and everything else. It's a consequence of that. But we could accelerate that by introducing a quote unquote safe digital currency, and that's why you shouldn't just do it, because it's a potential something that could create financial instability if you do it too fast and you don't think about those consequences. I think monetary policy makers are aware of that. But that's changing. But also that in itself will probably be, in the transition from one system to another, deflationary, and will likely push down interest rates. And I think what's going on in the world, the level of uncertainty in the world, means that central banks will be very reluctant to move fast ahead with these issues now, and I think they should be very reluctant. But it's clearly a factor that if we move towards that, and we're going to move on, if central banks are not going to do it, I think we're going to see within the next decade 1 or 2 or 3 successful alternatives to the Bitcoin that provides more elements of like normal money rather than Bitcoin. The problem with Bitcoin is that it's highly volatile. And you don't want to use a highly volatile currency as the currency you use for transactions. You want to have some stability there. But that's not the fault of cryptocurrencies in general or digital currency in general. That's a construction problem, so to speak, with the Bitcoin. That means it will never have that role as a normal something you use for transactions. But at least not in a simple form. But you're going to have monetary technological innovations that solve those problems, and I think that will happen. So we are moving towards, no matter what, even if central banks and government hate the idea, it is happening, and I think it should be encouraged, because I think it also ultimately will provide more stability. But there is a transition there that might not be completely non-volatile.
I think we have to end the episode here.
We could always do 4 or 6 hour episodes, but we better not go totally Joe Rogan here.
We once did a 2-hour episode about peg currencies.
Yeah, that was long
in Denmark, and that was super interesting. But we sometimes go over time.
That happens. These are important issues, and exactly. I didn't sum up 3 years of research project here, but I think we covered a lot of ground.
We definitely did. Thank you so much for participating.
Tak for, at du lyttede med til Rig på Viden. Jeg håber, at du lærte noget, og hvis du nu synes godt om vores podcast, så kan du støtte os ved at følge den på Spotify eller skrive en anbefaling på iTunes. Inde på LinkedIn, der kan du følge André Thormand, Benjamin Somofen eller Henrik Foged Rasmussen. På genhør.